IAS 16, property, plant, and equipment. So first of all, property, plant, and equipment is the backbone to all IAS non-current asset standards. Okay. Is my voice clearer? Is it very clear?
Yes, please. It's clear.
Okay. So when we talk about property, plant, and equipment, we are talking about tangible non-current assets, right? So when we say something is tangible, that means that it can what? It can be seen and touched, right? No, so.
So
We are saying that it is non-current assets. We know what assets are, right?
yes,
What
sir.
is the definition of assets? I taught you just a few days ago. It is what? Hey, what's the definition of an asset according to the framework?
They are economic resources.
Okay. Economic resources that are controlled as a result of past events, right?
From which what benefits can be.
Yes. So it's something that can generate you, that has the probability of generating you economic benefit, right?
Benefit.
So we are saying that when we say non-current, that means it secures a benefit of more than one accounting year. Not so. So they are tangible non-current assets which are held for, please, your background noise, everybody should be muted unless you have something to say. Okay, so that when you play the video, you have a good experience. All right, that's fine. If you have a question, you put up your hand. Please don't ever unmute unless your hand has ever been up. I beg you. So the background noises will be minimal. So there's something that these non-current assets are used for. One, they are held for either production and supply of goods and services. Okay. Two, they are held for administrative purposes. And three, for rentals if they are idle. Okay. Okay. So if I hold properties, okay, or plant and equipment, so when you hear the word property, property in accounting is actually land, building, okay, part of a building, okay, or both land and building. So anytime you hear property in accounting, we are looking at land, we are looking at building, we are looking at part of a building, we are looking at both land and building. Do you understand? That's what we call property. So under PPE that we've seen that, okay, if you have any tangible non-current assets, that can be held for producing and supplying, like your cars, your other assets, your computers, for admin purposes and things that you rent, then we are saying that these assets will be called property, plant, and equipment, right? On the account. But the thing is, the property part of PPE is what we call owner-occupied property. The property part of PPE is called owner-occupied property. So anytime you have land and building, okay, that you use for your office, let's say your office building, your factory building, the ones that are used for production and supply, the ones that are used for admin purposes and rentals, if they're idle, they meet the definition of PPE. Do you get it? And any property under PPE is called owner-occupied property. But if I have a property which I'm solely renting out, then it is what we call investment property. So PPE can also be used for rentals. Yes, that's the property part. So anytime you hear IAS 16 property, it is called owner-occupied property. Property that you use to work. Remember, investment property, you the owner, you don't occupy it. Do you understand? You don't occupy investment property. But property, plant, and equipment, the property part of it, you occupy it. So it's owner-occupied. You either use it for your office building or your factory building, or you use it for work. Okay, so property under PPE is called owner-occupied property. I want it to sink in, right? So land, building, part of a building, or both, that is used for production and supply of goods and services. Okay, that is used for administrative purposes, and that is used for rentals, are what? Called owner-occupied property. Good. Now, that is the definition of PPE. So we have now seen PPE. So when do we recognize PPE? PPE and all other assets which are tangible, You recognize them if one, there's probable what? Economic what? Benefits that is going to flow to you. And we said something that under the new framework, right? The probability should be more of a measurement criteria. I get it, but we still have to assess whether it's probable that that economic right, remember we said it's an economic resource. So there's a right. Do we have a right to receive some sort of cash flows if we receive this? Yes, that office building that you have, are you using it to produce, to generate something in return? Do you get it? 2, can you measure the cost reliably? Okay, measurement. So you are looking at what? Reliable cost. Okay. Does it make sense? So that is how we go. So the cost must be measured what? Reliable. So reliable measure of cost. So imagine I have something I want to bring onto the financial statement. So recognition is, should it hit the balance sheet or P&L? What criteria must it be met to hit the P&L and the balance sheet, right? So that is it. So we have seen what PPE is. We have seen that the property part of PPE is what? Owner occupied. If we say owner occupied, it's property that you're using to work. So it is covered under IAS 16. And then we've seen when we have to recognize assets, that is to bring them. So I can even bring the most important here. First of all, to bring PPE, that should actually be the first. So I should meet the definition of PPE. Okay, that's the first one. Because if it doesn't meet the definition of PPE, why do you recognize it as PPE? So it should meet the definition of PPE first. Then you now ask yourself, do I get something from it? Can I measure the cost reliably? So that is it. Per the new framework, I think this is highlighted. Very important. So if we decide, okay, the thing has met the definition of PPE, good. So we now have to measure it. So should it hit our account? Yes. If so, at what value should it be? At what value should it be? And this is what we call measurement. So you said, okay, this guy should come onto our account. Okay, but at what value should he come? Because if you to hit the account, it needs a value. Okay, so with measurement, we always have 2 ways to measure. The first time you bring that visitor to your house, where should he sit? And then subsequently, year on year, when he comes, would he still sit at the same place? Assuming you don't know me, I come to your house. Yes, maybe the first time I'll sit on your veranda. But subsequently, year on year, how would you recognize me? Do you get it? So initial measurement is always initial measurement. Okay, the first time it hits your books, and then we have subsequent measurement. Subsequently, year on year, how do we treat it? And this literally applies to almost all the standards. And if you keep learning like this, you will be fine. So initially, PP is always measured at cost. Okay? Subsequently, we can choose between 2 models, which is either the cost model, where the asset is carried at the carrying amount, right? Cost minus any accumulated depreciation and accumulated impairment losses, okay? Or we can choose between the revaluation model, where the asset is carried at the revalued amount minus any accumulated depreciation and any accumulated impairment losses, okay? So initially it's at cost. Subsequently, that's year-on-year changes. We use what? The cost model or the revaluation model. Now, since we said PPE should be measured at cost, we must know the components of cost, that cost. So the initial measurement of PPE comes at the initial cost. So what is the initial cost? When you first get a PPE item, we value it at its what? Its cost. And what is that cost we are talking about? 1, we should include the purchase price of the asset. Okay. Any directly attributable cost, so any expense that we incur to get that asset ready for its use, like transport, installation, shipping and handling charges. And then if we have any borrowing costs, any dismantling or restoration costs in line with IAS 37. But included in the purchase price, right? If you get a trade discount, so usually let's say you bought the thing, right? Or you constructed it. So it could be purchase or construction cost, because it's not every asset we buy, right? Some assets we manufacture it ourselves. So whether purchase or construction, these assets, you have to, incur them. Then apart from there, for instance, if I give you a trade discount, I will have to take the trade discount out. In accounting, we have two main types of discounts: cash discount and trade discount. Trade discount is what they give you at the market. Oh, jeans were saying, oh, this jeans is 200 cedis, but master, give me 1.8. Do you understand? So 180 cedis, you see, we took 20 cedis off. That 20 cedis is the trade discount. Trade discounts don't hit our accounting books. It is cash discount. Okay, pay me. If you pay me in 14 days, I'm going to give you a discount of 5%. That is a cash discount, or what we call a settlement discount. That is what we know in accounting as discount allowed and discount received. Okay? But trade discounts, they don't hit our accounting book, so you take them out. Okay? So that is what we call trade discount. Then, if there are any non-refundable taxes, okay? So let's say there were non-refundable taxes, like in Ghana, for instance, we have NHIL, Get Fund, okay, and COVID-19 levy. Okay, these ones, you can't get them back. So it's added to the cost of the PPE. So if you import some plant to Ghana, by all means, you would have paid import NHIL, Get Fund, those taxes that cannot be refunded, you will add it. But if they are refundable taxes, okay, if they are refundable taxes like VAT and those things, which are part of the cost, they don't belong here. It must be taken out. I'm giving you the full construction, right? Now, this literally gives you what we call the transaction value if you bring it from other countries here. Then when you have to transport it, you have to do other things like directly attributable cost. By all means, you have some directly attributable costs, the cost that you incur to bring it to its present location and condition for it to operate well. So with directly attributable costs, when they are shipping and handling charges, let's say shipping and carriage, right? So you brought it, you incur some carriage costs, carriage inwards, right? You have to add it up. Maybe you have to pay some lawyer to do some due diligence, so legal or professional fees, maybe some architect, okay? All those costs will be added. They are directly attributable. Pre-production costs, even with pre-production costs, you have to check, okay? But usually something like pre-production testing, okay? You have to test the machine, okay, before you use it, all those things, you need it. Installation, site preparation, all these things. Fill it from the question, right? So installation, site preparation, all these costs must be added. Okay, so once you add all these costs, assuming the asset was a qualifying asset, it's an asset that takes a long time to get completed. Okay, it's an asset that will take a long time. Let's say a bridge you are constructing, and you go and borrow a loan to construct that bridge. Okay, that means that the interest on that loan can be added in accordance with IAS 23. So interest expenses on qualifying assets. So if it's a qualifying asset, then the interest expense under IAS 23 must also be added. Okay. Now, if there's future dismantling costs, so we need the fair value, okay, which is literally the present value of any dismantling cost. So if you have to dismantle this asset in the future, then you have to estimate the present value and add it. So all these directly attributable costs, if you add them up, you should get the cost of the PPE. Okay, very important. Okay, so we've seen the things that we can include, but there are some things that are not supposed to be part of PPE. All right. So one, general overheads. Okay, so let's say you are building a plant. Then you have the MD salary. The MD salary, how can it be included in the cost of the plant? The MD is not directly involved, right? But if I have labor cost, the masons, maybe material cost, cement cost, those things, yes, it goes into the construction of the bridge. But the MD salary is a general overhead, like office administration. Yes.
Please, the refundable taxes. Why are we excluding it?
I'm not excluding it. They are included. There's a difference between deduction and exclusion. Get it different.
Deduction, sorry. Deducting it. Why are we deducting it?
Yes, because it's refundable. It's not supposed to be here. Something like VAT. We don't include it in the cost of the asset because we claim it separately. Utia VAT. VAT yemfanka asset ne ho. VAT, we create a VAT account. It doesn't even belong to you. It's government. You claim it as an input tax.
Yes, sir.
Do you get it now? Okay, so exclusions. When we have general overheads like admin, salary, those things, unless they are directly attributable, we don't add it. Okay, settlement discounts. So if I tell you, oh, pay me in the next 15 days, okay, and then I will give you 10% discount. It shouldn't form part of the cost of the asset. Settlement discount, we can't add. Also, when we have initial operating losses, let's say that when we started using the machine, okay, we produced some goods that made us losses. We can't charge it to the cost of the asset. It should be excluded. Okay. Other things that you have to exclude is maintenance cost. So this maintenance cost, unless you did the maintenance as part of the installation and all that. So you bought a machine, right? The machine was damaged. You had to repair it before you use it. Yes, so that repair cost there, you can include it in the cost of the asset. But however, if you are doing frequent or regular maintenance, let's say, okay, after you install this machine, right, you are going to do maintenance for the next 5 years or some support services. No, those ones, we can't add it because it is after the asset is ready for use. Do you get it? Then if you have training costs, okay, training costs, let's say you are training people to use the asset. Yes, it is an after cost. But if I have to train some technicians to do the installation, it's part of installation. You ask yourself, say, it's like relevance. Is it relevant to what we are doing, like the installation, site preparation, and the rest? Right? If you have errors in estimation, anything involving errors and those things, they are excluded. Okay. So anything within this space, the question will speak to you. That will tell you whether, oh, this thing we have to add it, this thing we don't have to add it. Do you get it? So that's how it works. So these are the initial cost of an asset. And this thing you are seeing also applies to investment property. It applies to lease asset, but lease asset, I'll come and show you one or two few things, right? But this same concept can be dealt with intangible asset, just an intangible asset. They will not have some of these, but it's the same thing. All right. The same thing can be applied to any tangible asset, even under leases. Yes. So for leases, once we get our lease liability, any directly attributable cost will also be added, just like this. Any dismantling cost, if you have to dismantle the asset, will have to be added. Do you get it? So all these things we are learning, once you know one, you know all. That's how these things are. That's why at corporate reporting level, I don't think students should learn the standards in isolation, that this is just IAS 16. Because of something I introduced to you last time, which we call compound what? Compound questions. Do you remember?
Standards.
Yes. So the compound standard questions, they mix the principles. So get the principles rather than say, this is IAS 16. Do you get it? Because a transaction may come and they will not ask you directly, say, where your IAS 16, where your IAS, no, just know what is happening and be able to comment the kind of standard that is being examined, how we should be able to treat it and all that. Okay, so let's take a question on cost, just a simple question, and let's see if we can do it. All right. So ABBA Properties Limited, a Ghanaian real estate developer, commenced construction of a new head office building. So head office building, what kind of property is this? Is it, what will we call this kind of property? Head office building.
Owner-occupied.
Owner occupied. What if it was a rental property? Then what we call it? Investment what? Property. Okay, so one, purchase price of land. Do we include it?
Yes, please.
Yes. Stamp duty. Non-refundable tax, do we include it? Non-refundable tax, do we include it?
Yes, we include it.
Yes, you can't get it back. So it forms, it's your worker, it is your cost. Legal fees to register this asset, do we include
Inclusive.
directly?
Inclusive.
Site preparation and clearance, do we add?
Included.
Included. Materials, do we add? Directly attributable? No, so we need materials to build. Labor, from 1st April to July 2025, do we add?
Yes.
Yes.
Labor, directly attributable. The architect's fees, do we add?
Yes.
Yes. General overheads, do we add?
No.
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 Directly attributable. You remember I told you. So let's go to the notes and see whether truly we can get the cost. They said material costs were higher than initially estimated. Upon investigation, it was discovered that materials costing 10 million has been spoiled and therefore wasted due to inefficiencies. So that means the material cost that we have at the top here, where is it? This 100,000. How much is supposed to be recorded? This 100 million. How much is supposed to be
90.
90 million? Why? Because some of them were spoiled or some of them were due to inefficiency. So they are not part of the cost of the PPE. Does it make sense?
Yes.
50 million was incurred as a direct result of faulty design work. Faulty design work. Should it be in there?
Yes.
Faulty design work. Should it be in the cost of materials?
No, please.
Do you understand? It cannot be. So it's an inefficiency. I told you, inefficiencies, errors, losses. We can't include it there.
Yes.
So
Yes.
you have to take 25 million out of the 100, right? Which
Yes.
results 85. Okay, as
Mm.
a consequence of this work on the building was halted for 2 weeks during October, and it is estimated that approximately 9 million of the labor costs relate to this idle period. So labor costs, there's 9 million in there that shouldn't be there, right? You also take it out. So simple. And one new. That's all. And this question is simple. Yes, please.
Sorry, for the work being halted for 2 weeks, wouldn't that have anything to do with okay, sorry, I was thinking about borrowing costs, but I think it doesn't relate. Yeah, sorry.
So that is it. It's very simple. But then you can chip in an assumption. Okay, if the work was halted and I'm paying labor the same amount, then I think that one may not have an effect if you are looking at it from that standpoint. Because if I'm paying you 9 million for work done, and during that period, the 9 million is to be paid to you and you're not even working, does it relate to the PPE? That's a question you have to ask yourself. Does it relate to the PPE? Depends. Do you understand? Okay, good. So we now look at, after I've initially recognized this asset, okay, my next question is this. What about costs that are subsequent, like subsequent expenditure? Okay, not subsequent measurement, like from the first day you recognize it, let's say you incur additional costs. What do you do to them? So expenditure incurred on non-current assets after initial acquisition is capitalized if it meets the asset recognition criteria. Does it meet the definition of an asset? So for instance, look, I have recognized my car, okay? Or let me just use a building rather. Okay, so let's say I recognize my building at 250,000, okay, on the accounts. Then later, I just paint the building. Can I add this painting to the cost of the building, or I should expense it?
It should be expensed.
Should be expensed.
Be expense because this is regular maintenance, right? A revenue expenditure. So subsequent expenditure, we say, yes, please.
The painting before the building will be put to use, you paint it before subsequent maintenance.
Recognized already. Yeah, record the building at the da. Do you get it? Maybe do you get it? Now, after yeah, painting, later painting, not the original painting. Let's say we are just trying to the painting fast.
Change the color. Okay. Okay.
So like we have already painted it, but here we are just maybe doing some restructuring. So we decided to paint the building. Do you get it? This one is more like a regular maintenance because building definitely you will be painting it. It doesn't really add anything to the economic benefits. Do you understand?
Okay.
I extend the building. I do an extension on the building. And if initially the building was taking 100 students that I teach, now the building is taking 200 students. That one, should it be capitalized or it should be expensed?
It should be capitalized.
Nice.
Why? Because it extends the assets, the benefits that we are getting for it, or it can extend the useful life, right? So if you see routine maintenance and repairs, you have to expense them as they are incurred, as they do not generate any additional future economic benefits. That's the rule. Okay, so you also have this at the back of your mind. You can get a question where you see subsequent costs. Those doing advanced audit, for instance, this one creates an audit risk. Somebody will ask, how does this create an audit risk? Now, anytime you see a question saying that, oh, they are doing restructuring, or they are doing restoration, or they are doing refurbishment, right? Definitely, then we know that definitely some of the cost will be revenue expenditure, and some will be capital expenditure, right? So there's a chance that the company would have mistakenly recognized capital expenditure as revenue expenditure and revenue expenditure as capital expenditure. And these features as part of normal audit questions. So what has been done wrong? It is possible that they have misclassified revenue expenditure as capital expenditure or vice versa, meaning that expenses can be understated or overstated on their accounts. What does the IAS say? The IAS says that if you have subsequent expenditure, the ones that relate to regular maintenance or routine expenses must be expensed, and the ones that extend the economic benefits of the asset must be capitalized. And this one, you get the full mark for this risk of material misstatement. Okay. Why do I mention those doing advanced audit? Even in corporate reporting, these audit risks are part of the risks or the threats, okay, that you are going to use when you are doing ethics. So please remember that ethics also has an accounting side. So if I say audit risk, it's not only those doing auditing, but under ethics, you can check why this has been done. And somebody might do this intentionally, which means it's a breach of integrity and objectivity, or unintentionally, which is a competence problem. Or do you care? He rushed in doing it. So you look at all the circumstances and talk about it. So that's the ethical part. Anything that involves judgment, ethics is always there. So that is about subsequent expenditure. Okay, so look at this. A machine is serviced at an annual cost of 10,000. Machine service, annual cost 10,000. Servicing. During the most recent service, it was decided to replace an important part which will result in faster work, and the machine will produce more units of product per hour. The cost of the replacement is 20,000. How should these expenditures be recognized? Yes. Which one is capital in nature and which one is revenue in nature? Yeah, someone should put his hand up and answer. Which one is capital in nature and which one is revenue in nature? Which one will be expense and which one will be capitalized? Who will
Hello,
try?
sir.
Yes, please.
Please, the 10,000 will be expensed and the 20 will be capitalized
Okay. Any reason?
because we are told the servicing is an annual
Yes. It's an annual servicing.
service.
The replacement of the part is a huge component, right? Like if you have a car and you change the engine, it's a huge component because without the engine of the car cannot work. Do you get it? So me changing the engine is not just normal maintenance, but a huge or major overhaul. Do you get how this works? Is it clear to everyone? Is it clear to everyone? All right, so let's move. So let's look at major inspections and overhaul costs, just like the engine I was talking about. So if as part of the continuing operations of the asset, you maybe buy an engine or some huge component which requires replacement, what you do is you de-recognize the other part and recognize the new part. So let's say that in the car, you have engines as a separate asset, okay? So it means that you take the old engine out of your book and recognize the new engine in your books. Are we okay?
Mm.
Good. All right, so that was it. Now, the next thing I want to talk about is revaluations, right? For the cost model, it's so easy. You are recognizing the asset at cost, that subsequent measurement, right? I told you can choose between revaluation and then what? The cost model. So under the cost model, we recognize the asset at depreciated cost, meaning you take the cost of the asset minus what? The accumulated what? Depreciation, and any accumulated what? Impairment what? Losses. This is very important. So that's the carrying amount of the asset. Now, listen carefully. We know cost already, but we don't know depreciation. What is depreciation? Depreciation is simply the systematic allocation of the depreciable amount, okay, of an asset over its economic useful life. So what is depreciable amount? Depreciable amount is simply your cost minus your residual value. That's what the asset will be worth at the end of its life, right? So your cost minus residual value is your depreciable amount. That means that if I look at this definition of depreciation, systematic allocation of depreciable amount, which is cost minus the scrap or residual value, all over the useful life of the asset. Okay, so this is the definition of depreciation per the standards. Are we okay? Now, we are saying that, okay, when you are doing depreciation, there are many methods. I mean, there are many methods, so many methods of depreciation. But at your level, I'm not sure they'll give you any methods other than the straight line, because of you have other things they can ask you. Straight line, reducing balance, maybe some of ES digits. Well, some of ES digits. At your level, we don't use double declining balance. We have the weighted average method. We have machine hour method, and so on and so forth. But for CA, mostly maybe this worst case scenario, and then the machine hour method. Okay, all of them, I'll just show you how they actually work in simple terms. Then you just get it. Straight line is the first one I want to talk about. With a straight line method, I'll give you all the different ways you can do straight line. Okay, so that you don't have any problem. So the first way to do straight line is when depreciation is given as the normal way. So you just take your what? Your cost minus scrap over useful life, right? So this is where you do cost minus scrap value, or the residual value over the economic useful life, right? Now, this is the common type where I tell you that an asset has cost of 200,000, right? It has scrap value of 10,000, and you are using it for 10 years. So you get the idea. So this one, depreciation per annum becomes what? 190,000 divided by what? 10 years, right? That means it's 19,000 per year. Okay. Now note, the depreciable amount that we saw, which is cost minus the scrap value, is the same as the total amount of depreciation over the asset's life. Do you all agree? Do you all agree?
Yes, sir.
Do you all agree? Do you understand what I mean?
Please go over again.
Yeah. This asset, Meboa, what is the depreciable amount? What's the depreciable amount of this asset?
Isn't
19,000.
19,000.
Depreciable amount. Hey, I just gave you the definition of depreciable amount. Depreciable amount is cost minus residual value. I never said depreciation. What's the depreciable amount?
200,000.
190.
190,000.
Because depreciable amount is cost minus scrap or residual value. Okay. Now, what do I mean? I mean that at the end of the day, this depreciable amount should amount to the total depreciation of the asset. When the asset's life is due, let's see. Now, this asset has how many years? 10 years, Meboa. If I do 19,000 depreciation by 10 years, what does it give me? Doesn't it still give me the same 190,000? Does it not give me back the 190?
It does.
The reason why I'm giving you this is some questions are very slick, okay? They can do anything. They can give you the depreciation for 1 year, or they can give you the depreciable amount. They can give you anything. So you need to know these terms, right? Good. So now you understand that the depreciable amount is also equal to the total depreciation over the asset's life. Meboa. So this is the first way we do straight line. Now, the second way we do straight line is when you have a percentage of the cost of the asset. Okay, so a percentage of cost, they can tell you that, okay, 10% on cost is depreciation. So you just do 10% on the 200,000. Okay, and this gives us what, 20,000 as the depreciation per annum. Very straightforward. The third way we do straight line is what I am mostly concerned about. Okay, so that one is where you take your cost, or I prefer carrying amount, not cost, right? So that one is your carrying value, or anything that is left with the asset cost. Okay, so carrying amount or any value. So any value left on the asset minus the residual value over the remaining life. So this one is even more important than the ones at the top, because anytime something changes on PPE, the useful life, or it is revalued, or it has been impaired, or whatever we have, this is how we get depreciation. Okay. And for reducing balance is rather simple. Straight line can mess you up if you are not very smart. Okay, so the carrying amount, okay, or the revalued amount, or whatever value has given, the recoverable amount, any value, that's why I said whatever is left on the asset, any value minus the residual value, if any, most of the time you would have residual value over the remaining life. So what do I mean? So look at this. An asset had a cost of 100,000, okay? And this was on 1st January 2020, okay? Now, depreciation on this asset, let's say depreciation was 20% on this 100,000 per annum. Are you following? 100,000 per annum. That means that will give us 20,000. It was 20,000 per annum, right? So now, if I'm standing at, let's say, 1st January 2024, it means that I need to travel for how many years? How much becomes my accumulated depreciation? It means I need to travel for how many years?
4 years.
So accumulated depreciation, that means we'll have what, from 2020 to 2023, right? So we have 2020, 2021, 2022, 2023 is 4 years. So we have 4 years by the 20,000. And that gives us what? That's accumulated depreciation of about 80,000 also. If I take it out, that means my carrying amount is as at what? The 1st January 2024. And this 2024, I have 20,000, right? But now, this is the carrying amount of this asset. Okay, let's say that assuming it was revalued, okay, assuming it was revalued, then you get the revalue. But assuming I want depreciation, I already know depreciation is 20,000. I have to take it out to make it 0. But the same way, how many of the asset's life has been used? How many years have we used from the asset's life?
1.
No, we bought it in 2020. We are in 2024. the beginning of 2024, how many years of the asset life have we used? It is here, 4 years.
4
Year
years.
2020, we are standing in 2024. How many years have passed?
4.
4. So the same way, since this is straight line, I can equally say, okay, what was the useful life of the asset? What was the useful life of the asset? How do we know this? You see, if depreciation is given as a percentage, the useful life is given as just taking 100 over the depreciation percentage. Okay, so with this asset, because it is 20% to get a useful life, this only works for straight line or reducing balance. No, you see, reducing balance, you can't do this because reducing balance is a formula we use to generate the percentage. Okay, so this means that if you take 100 out of the 20, it means the asset has how many years? 5 years. Do you get it? So if it has 5 years automatically, and you have used 4, it means you have what? How many years remaining?
4.
4.
1 year.
That means that you can get depreciation still doing your normal 20% on what? On the cost. Which is what? 20% on what? What was the cost? The 100,000, right? Because straight line depreciation will never change until something has changed on the asset. So 20% of 100,000, that gives us what? 20,000, right? Equally, I can decide to use this approach. Okay, I can say that, okay, my depreciation is still taking my carrying amount over the remaining life. Not be so. Let's see if we'll get the same thing. The carrying amount now was worth what? 20,000. Maybe what? Remaining life is now 1 year. Don't you still get the same 20,000? Is it the same? Is it
It's
the
the
same?
same. It's the same.
Yeah. So anytime you have something left on the asset, like a value left on the asset, once you divide by the remaining life, you get the same depreciation. I want this to be in your head because this thing is like the backbone of all the PPE or all the asset standards which you are going to use. Are we okay? So this was how we deal with straight line. The second method is what we call reducing balance. Now, reducing balance is just a percentage on the carrying amount at the start, right? So if I bought this asset at 100,000, like the question we did, and there was what, 20% reducing balance, okay? And the asset has no scrap value. This is what it means. It means that in year 1, okay? In year 1, I recognize this, right? There will be what? Depreciation of what? 20% on this, right? Which will be what? Because at this point, the carrying amount is still the same as the cost. There's no depreciation. So this gives us 20,000. Also, we take it out. We have 80,000, which becomes like the carrying amount that goes to year 2, right? The same way we'll do depreciation of what? 20% again on this. So you see that the depreciation is computed on what? The carrying amount, not the cost. Can you see? So 20% of 80, that's how much? That's about 16,000 also. We take it out, then you get the carrying amount that goes to year 3. And that gives us what? Is it 64,000? So you have depreciation again, 20%. That goes to what? Year 4, right? The year 3 depreciation. That gives us what? Is it 12,800? Am I on point?
12,800. Yes,
Yeah, so
12,800.
carrying amount that goes to year 4. So 64,000 minus 12,800. What
It
do we
will
get?
be 51,200.
Okay, 51,200. Now we need depreciation again. That takes us to the last year, right? 20% of this, that's how much?
10,240.
So we take out the 10,240, okay? And that gives us what? The carrying amount that goes to year 5, right?
4960.
40.
960.
But here lies the case. If this is the last year, let's say it was going for 5 years, and this is the last year, that means it will be wet scrap, right? It's scrap value. But this asset, if it has nothing, that means the scrap value is worth 0. So the balancing figure becomes the additional depreciation for the period, which is the balancing figure. So this same 4960, are you getting it? This will result in 0 if the asset is wet. So you always compare to the scrap. So this is how reducing balance works. It's on the carrying amount. So if they give you, let's say you are doing something like reporting, they give you the trial balance, debit, credit, right? Then they say what? A plant at cost, 100 million, right? How am I putting in that credit? Plant at cost, 100 million, right? Then they give you accumulated depreciation on the plant at, let's say, 20 million. And then they say what? Depreciation is given for plant at what? At 30%. 30% reducing balance. That means that to get the depreciation, you are going to have to take the 100 minus the 20, right? Get your 80 before you apply the 30% on it. Do you get it? So reducing balance is on the carrying amount. Does it make sense?
Yes, please.
Good. These things are basic accounting. You should do this in financial accounting, but I'm still going to take you through again. So how is depreciation recorded? This depreciation that we've gotten, right, for each year goes into the accumulated depreciation account. In old accounting, you say provision for depreciation. Okay? Provision for depreciation. Or accumulated depreciation account. That's what we call it. So in modern reporting, we say accumulated what depreciation. And the same way you treat depreciation is the same way you treat impairment. So depreciation and impairment are literally the same treatment. So I'll use the account here first, then I'll come and use the systematic way we do it. Okay, so in that case, let's say that this depreciation is a counter asset account. So anytime you have a counter asset account acts like a liability. You see, assets have a debit balance. Anything that reduces an asset must have the opposite balance. Do you get what I mean? Receivables, assets, right? Provision for receivables or allowance for bad debts are a counter asset account. It means it reduces receivables, so it's the opposite balance. Do you get it? Impairment. Impairment is an expense, right? But accumulated, it reduces the cost of PPE, so it's a counter asset account. Makes sense?
Yes, sir.
Good. So provision for depreciation, since it's a counter asset account, this account has, please don't confuse it with depreciation expense. Depreciation expense is an expense, so it has a debit balance. But this is the accumulated depreciation account. It means that if I take this account for the first year, year one, then what is the opening balance on this account? There was nothing here. But in the first year, we had what? Depreciation expense going for what? The first year, 20,000 Mebwa. Now at the end, what happens? This still gives us 20,000 carried forward, right? 20,000, 20,000. So that means balance carried forward to year two will still be 20,000. Makes sense. If we go to year two, now what do you see? You see this depreciation expense, you see it goes to P&L. Not be so. So since it is in the P&L, it will be debited as an expense. But in actual sense, it is not a straightforward thing like that. Actually, this one goes to the depreciation expense account and it is cancelled out to P&L. But that is that's how actual accounting is supposed to be done. So this one, sending it to P&L straight, actually, this one will go to what we call the depreciation expense account. Okay. Then it will be like, okay, this one came from what? Accumulated depreciation account. How much? 20,000. Then you say profit or loss. 20,000. So literally, profit or loss cancels this off. Then in the profit or loss account, it will go to the debit side. But why do you go through all this stress when you can just take it from credit and debit it in P&L? So you see how accounting is. So this is just basic accounting, like level SS level accounting. All right. So what you do is that in year two, the same thing. Once the balance brought forward, in year two, I'm just doing 2 years to show you. In year two, this 20,000 will come here, right? But then we'll have depreciation expense again, which goes to your P&L, right? And this depreciation expense was what? For the year two was 16,000, right? So accumulated depreciation in that year is now 36,000. No be so. So in that case, you are saying that therefore your balance carried forward for year two is now 36,000. which this 36,000 will now go and reduce the PPE, right? So if I do year 1 and year 2, remember that we had cost of the asset being what? The 100,000 we acquired, right? But then less accumulated depreciation or provision for depreciation. The first year was 20,000, resulting in what? 80,000. And this year it is 36,000, resulting in 64,000. Make sense? Make sense? So for depreciation, you add it. It's cumulative. All right. Are we okay with depreciation?
Yes, please.
Okay. Now, how do we do with sum of years digits? Sum of years digits, you are just summing the years and apportioning the depreciation over the number of years. So let's say that we want to use this asset for 5 years, right?
Prof,
5
please,
years.
we are writing. Oh, some of us are writing.
Okay. So you can put it down. But please be fast. Because within some few minutes, I will skip.
One screenshot and copy later.
Okay. Can we go?
Yes, please.
All right. Now, sum of years digits, you see, I use the same 100,000 throughout, but different methods. So now you're saying that, okay, the cost is apportioned up in line or taken over 5 years. So what you have to do is you are going to sum all the years. And this technique will be very important when it comes to leases. Okay, very important. So sum of years digits is literally used almost every time. All right. So what we are going to do is that we are going to sum all the years. That means that it's 5 years. So you sum 1 plus 2 plus 3 plus 4 plus 5, right? And when you sum all, what do you get? 1 plus 2, 3 plus 3, 6 plus 4. That's how much? 10 plus 5, 15. Okay. But this is a cumbersome process. What if the asset had 100 years? Okay. What if this asset had 100 years? Are you going to add 1 plus 2 plus 3 up to 100? No, there's a shortcut. So to get the sum of the years, is simply n plus 1 over 2. Okay, this is Gauss method. So what you are saying is that, okay, anytime they tell you to sum numbers, you are summing for how many years? 5 years. So just take 5 into bracket 5 plus 1, which is 6 over 2. And this is 30 over 2, which is 15. Simple. Makes sense. So this is how we do sum of years digits. So you just sum the number of years and apportion the asset cost in that manner. That's all. So in that case, if I'm standing in year 1, the first year, then I have 4 years remaining, right? So depreciation, let me say depreciation expense, then my accumulated depreciation, right? So let's see. In year 1, it means my depreciation expense will be what? I'm standing in year 1, so I have 4 years remaining, right? So 4 years remaining, 5 years remaining, sorry. Starting in year 1, the start of year 1, so I have 5 years remaining, right? Out of the total 15 times the what? The 100,000. What becomes my expense? Do you get how it is done?
25.
Right? That's 25.
Is
Is it 25?
No.
So why did you give me 25? 33.
Yeah, 33.
Okay. Please, is everyone following?
Yeah.
Okay, so that means accumulated depreciation is 33. Okay, now in year 2, we have 4 years remaining out of the 15 times 100,000, right? Are you following how it is done? So 4 out of 15 times 100,000, that is 26,666 or 667. If you add it to the 33,333, we end up with what? 60,000, right? Okay. So year 3, we have what? 3 out of 15 times 100,000. Okay. And that gives us 20,000. So accumulated depreciation now becomes 80,000. We go to year 4. We have 2 years out of the 15 sum times 100,000. So you have 13,333. So accumulated, that's 93,333. So you come to year 5, the final year, which is 1 year remaining out of the 15 times. Okay. And that's 6,667. And this one gives you back the 100,000, which would have eaten up the asset from your books. So this is how we do sum of years digits. Very simple, right? But some people have not seen it before. Assuming they saw it in exam, it will disappoint them anyway. All right. Any question on sum of years digits before we look at machine hour method and then we move? Yeah, before.
Prof, my question is, they say with the sum of year digit here, the accumulated depreciation is able to eat up the cost of the asset. Now, should there be a scrap value? How do you treat it?
Oh, then there's if a scrap value, then you are going to apportion the depreciable amount. Well, what do you get it?
How?
Apportion the depreciable amount. What is depreciable amount? But for the question is for you. What's depreciable amount?
The total depreciated value.
I said, what is depreciable amount? You are not giving me the the definition I gave you. What is depreciable amount?
The difference between the cost and the scrap value.
Thank you. So let's see. Assuming this one had a scrap value of 10,000, try it and see. It means that we are going to say that, okay, the depreciable amount is what? It's 100,000 minus what? 10,000, giving us 90,000, right? So is this
Yes,
90,000 that you now do this for? And you will be left with 10,000 at the end of the day. Everything here will now become the 90,000. Try it and see.
So 5
out of
yeah,
15.
1 will be 5 over 15 times 90,000.
Then like that, then you are going 4 out of 15
Okay.
90. Let's do it. 3 out of 15 times 90. 2 out of 15 times 90. 2 out of 15 times 90. 1 out of 15 times 90. Okay, so in that case, I will just say, let me just put cost here, accumulated depreciation rather, then, or cost depreciation and then carrying amount, right? Cost depreciation carrying amount. So in your depreciation now, we just take it out from the cost. So the cost was 100,000, right? So the first year, what was the accumulated depreciation? That's 5 out of 15 times 90,000. That's the first year, right?
30,000.
20,000, right? So
30.
okay, we take
Year
it
1.
70,000, right? Okay, year 2, we bring the 70,000 forward. I'm just saying, right? We bring this 70,000. What's the depreciation again? 4 out of 15 times 90.
24,000.
How much?
24,000.
24,000. So what are we left if we take it out of the 70?
46,000.
So 46,000, right? The third year, 46,000. So depreciation, 3 out of 15 times 90.
18,000.
Take it out. What do you get?
32.
Okay, the same way. Okay, the next year.
12,000.
How much?
12,000.
12,000. What do we get?
20,000.
1,000. Okay. So we bring that 20,000. 1 out of 15 times 90.
6,000.
This is 6,000.
No, sorry. 2 over 15. 12,000.
I said 1 out of 15 times 90. Yeah, the last year.
Okay, 6,000.
So what are we left with?
14,000.
14,000.
Prof,
Yes.
There was
please,
a
the
mistake.
current amount for the third year is wrong. It's supposed to be 28.
Yes,
That's why it's not. It's not.
yes, 28. Yeah.
So 28,000. Okay. So 28,000. We bring the 28,000 here. So the 12,000 is also wrong.
Yes, please.
So what do we get then?
16.
60.
No,
Yes, please.
the 12,000 is not on the carrying amount.
So what do
Hello,
we have?
Prof.
Eh?
That is two. That is 2 over, the fourth year is 2 over 15 times 90,000.
Yes, all the years is over times 90,000.
So 12,000 is correct.
How is it correct? So how did they get the 16? Please, you are confusing me. Oh. I've given you the formula here. This is all we are doing.
So, Prof, the depreciation is 12,000 and the current amount will be 16.
Oh, okay. So you have to inform me. I'm not calculating, so I don't know. So this is 12,000. So you mean this is rather 16, right?
Yes,
Yeah.
please.
Then the last, this is 6,000. So what are you left with?
10,000.
10,000.
Are we not left with the scrap?
Yeah.
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 Or are you okay now?
Yes, Prof. I'm okay.
So that's how we do sum of years digits. Hardly would they ask you. Now, machine hour method is simply allocating the asset over the. This one is mostly man accounting, right? So hardly, but they can ask you. So the asset cost was what? 100,000. They told you that the total machine hours over the period was, let's say, 20,000 hours, right? Okay, and then maybe they tell you that to cost of sales, you allocate this number of hours, or you have maybe department X. Okay, this machine is used for the department. Department X uses maybe, or year one. Okay, let's see, or the period. For the period, we are using maybe, so this the lifetime. Okay, the lifetime machine hours. So this asset has a total hours of 20,000 hours over its lifetime. Okay, so its life is measured in hours. So in this year, let's say 2024, we have decided to use what? 5,000 hours of the asset. So in that case, our depreciation per hour will give us what? That's 100,000 divided by what? 20,000, right? That means what's our depreciation per hour? What's our depreciation per hour?
5,000.
No, it should be 5. Or?
Yes, it's 5, sir.
So that means your depreciation is 5 CD per machine hour. So in that case, if I want depreciation for 2024, I know that depreciation costs me 5 CD per machine hour. But how many machine hours am I using in 2024? 5,000, right? No, be so.
Thanks to
So that means depreciation cost for 2024 is 25,000. If I go to 2025 and I'm using 10,000 hours, that means 2025 depreciation will become what? 5 CD per machine hour times 10,000, and that's what? 50,000. So accumulated depreciation will be what? 50,000. Okay, so if I'm standing in 2025, then my accumulated depreciation will be 75,000, which I'll take from the cost of the asset. So this is all about these methods. They are not difficult, but if you don't know, you don't know. That's how it is. Okay, are we okay with depreciation now?
Yes, sir.
And the cost model, right? Good. So now I want to talk about the revaluation model. So the revaluation model is where usually we have problems, students have problems, but you have to understand the rules, okay, of revaluation. So to revalue assets, the fair value should be your focus. So the asset is carried at its revalued amount. That is the fair value minus depreciation and impairment. Okay. And always when you are revaluing assets, you must always do it regularly. And the funny thing is this thing, sometimes it comes in questions and then they ask you to explain the process of revaluation or explain revaluation that has been done. So you have to talk about the rules. Okay. Always we carry these assets at their fair value. Okay, minus any depreciation and impairment. Revaluations must be reviewed regularly to keep the values fresh. Consistency is key. Apply the same revaluation policy to all assets in the similar group. No cherry picking. Cherry. No cherry. So we are saying that you can't do cherry picking. We can't pick cherry. So you can't say, oh, this building is beautiful. Let me revalue it. If you revalue one building, you have to revalue all your buildings. Does it make sense? So it must be consistent. We know the consistency principle in accounting. Does it make sense? And then we must revalue based on what it is worth in the market, not just its current use. What is it worth in the market? So we depreciate the new value. After the revaluation, we depreciate the new amount over the asset remaining life. Are we okay? So these are the rules. Now we already know how to do revaluations. We just compare the carried amount to the revalued amount, and then the difference is recognized. So let's see. Adwa Ventures acquired a brand new Trotro for 800,000 on 1st January 2018. The Trotro had no scrap value and was expected to run for how long?
20 years.
20 years. On January 1st, 2021, due to high demand for transport services, the Trotro was valued at a fair market price of 950,000. So what figure should Adwa show in a financial statement as at 2021? Very simple question, right? But it's brainy. You still need depreciation. The vehicle that I use to travel in any question, which is my Trotro, is called depreciation. So depreciation to me is a vehicle that is used to travel. So once I have the cost, it is depreciation that will help us travel from wherever we are to where we want to go to by reducing the cost to that level. Does that make sense? It's that easy. But the thing is, please, these things you need to practice. Corporate reporting is not easy. You need practice. If you don't practice, forget it. You can't use your eye to learn. No, it's not possible. You can't say you are watching how to fight, and then you go and fight. They'll beat you because you haven't experienced it. Your brain can only recognize errors first. So make the error, then you correct it. So on the D-Day, your brain will prompt you, don't make this mistake again. Or you did it the last time. All right, so let's see. We are dealing with Adwa Ventures, right? Adwa Manse. So Adwa Mansa. Let's see. So the first thing I always do when I get questions is that first I try to establish the cost of the asset, right? So first of all, when did we buy? 1st January 2018. What was the cost?
1st January 2018.
800,000.
Okay, so we bought it for 800,000. Good. Now we need depreciation, right? So what was the depreciation? They said 20 years, right? So I need depreciation. So no scrap value. So I take this 800,000 divided by 20 years. And that means that depreciation was what? That's like
40,000.
per year, right? Good. But then I need accumulated depreciation. I need to travel. Where am I traveling to? I'm in 2018. I need to time travel. Where am I traveling to? I'm a Thai traveler. Kweku the traveler. Where am I traveling to?
31st December 2020.
Yeah, December 2020 because it's 1st January 2021. So full years, right? And always depreciate full years first. So in that case, I'm going from 2018, the whole of 2018, to the whole of 2020. How many years? 2018, 2019, 2020. I see that people use their head and say, okay, 2020, 2018, 2020, 2 years. No, 2018 inclusive is 3 years. In exam, students make this mistake. You can use counters or straw. We beg you, or use your fingers to count. Don't assume, because you see, when you subtract it to 2018, it's just 2 years, but it is not. 2018 is inclusive. Do you get it? So don't just say, oh, 2 years. No, Check. 2018, 2020, 2018, 2019, 2020. 3 years, not 2 years. I beg you, are we all okay?
Yes.
So we have used this asset for 3 years of the 40,000, right? So 3 years of 40,000 accumulated depreciation there is in
120,000.
120,000. So out of the whole 800,000, we have used 120. So now we are standing at 1st January 2021, right? Which is the same as 31st December 2020. So the carrying amount as at that date was what?
680.
680,000. Thank you. Now, the same 1st January 2021, the asset has been revalued. Mebwa. To what?
950.
950.
9,000. It has gone up in value, right? So since it has gone up in value, what do we need to do? We need to increase it to its value, right? So this is a revalued amount, which is equivalent to its fair value on the market. So by how much has it gone up?
$270.
So there's a revaluation gain of 270,000, right? Which is an addition. This one, what we are going to do is that this revaluation gain, we are going to increase the value of the asset, which we have done, right? We increased it from what? It was 680, then we increased it with the revaluation of what? The 270, right? The same way we increase our revaluation surplus by the same 270. So 270 against 270. Makes sense? Makes sense? All right. So that is done. But we are going to 31st December. That means this asset also needs to be revalued. It needs to be what? Depreciated, right? So we need accumulated depreciation from what? From that February to 31st December, okay? We need depreciation. So getting depreciation from this date to this date is a whole 1 year, right? If it was some number of months, we apportion. So in that case, depreciation, I told you that straight line, we can always take whatever is left in the value over the remaining life. Good. So straight line, we know that the asset is now worth 950,000, right? But then how many years are remaining on the asset? The asset used to have how many years?
20 years.
20 years.
3 years. So how many years remaining?
17.
17. Good. So we take this 950,000 divided by 17 years times is for the whole 12 months out of 12 months. As if it was 6, you take 6 on 12. That is it. So that is just it. Very simple. Okay. So what do we get then for the accumulated depreciation up to December? $55,882, right?
Yes.
So in that case, that means we are now standing at 31st December 2021, where our carrying amount will be how much?
This is 882.
894,118, right? So this one is
894,11.
so
118.
there's a key rule. The difference between the old depreciation and the new depreciation should always be transferred to retain earnings, right? So most questions will tell you that, the ABC Limited does not make an excess transfer. So what it means is that anytime you revalue an asset for the first time, the difference between the old and the new revaluation, the new depreciation should be transferred. That means that the excess depreciation should be transferred to retain earnings. And the excess depreciation is what? Taking this 55,882 minus the original 40,000, right? Which is how much? The 15,882. No, so. So this one, you take it from the revaluation account.
Why not the 120?
120 is not depreciation. This is accumulated. We are looking at depreciation expense. Remember, this is 120 was depreciation for how many years?
3 years, okay.
So in that case, we debit the revaluation surplus by the 15,882 to reduce it from there. Then we credit what? To increase our retained earnings by the same 15,882. But this one, most questions will tell you that ignore it. But I'm showing you, I don't want you to miss anything. This should be done. So how then do we represent this? Remember, we record assets at what? Their carrying amount, and then depreciation, we record the expense. So in my profit and loss statement, so I'll say statement of profit or loss extract for the year ended 2021, right? So in that case, under expenses, what would I record?
Depreciation?
And so I record depreciation expense. For this year was how much? 55,882, right?
555,882.
Yes. Then when I go to the balance sheet, so P&L and OCI, I forgot. So when I go to other comprehensive income, I'll have what? Revaluation what? Gain. Okay. Which was also what? How much was our revaluation gain?
The revaluation gain was 27,000, 270,000.
That is good. Then when we go to our statement of financial position, under non-current assets, we recognize PPE, property, plant, and equipment. Which is the carrying amount we hold now, which was 894,118, right? So we record at 894,118. Then when we go to the revaluation surplus under equity, okay, it was 270,000, right? So under normal circumstances, you record the same 270, but here we transfer the excess depreciation. So the 15,882, right? You take it out and then you transfer it to retain earnings. So it means that here we lose what? 15,882. Then retained earnings will gain 15,882. Do you understand? But most of the time,
Sir.
oh, I just explained this here. That the excess depreciation is transferred. You take it out of the revaluation surplus and give it to retained earnings. It's a policy.
Okay.
And that is what I'm doing on the face. You see, I took minus 15,882 from here, and then I'm adding it to retain earnings. Can you see? That's what I'm saying. But most questions, it wouldn't be there. Okay, so it means that you just recognize your whole 270,000 here. Because most questions will tell you, assume that he doesn't make a transfer of excess depreciation. Makes sense? Are we okay with revaluation? Increase. Can we look at revaluation decrease? So
yes, sir.
Revaluation decrease for the first time, it's straightforward because we cannot reduce the revaluation account to negative. So when you have a decrease for the first time, it always goes to the P&L, indicating that the asset might be impaired. Okay, so what happens is that anytime an asset gets a revaluation loss, we must assess the asset for impairment to check if it's actually impaired. But the first treatment of revaluation loss is that straightforward, just like impairment, it goes to your P&L unless previously revalued upwards. Okay, then what you do is you go and first cancel the previous gain or the previous revaluation gain, and then the excess or the difference goes to P&L. All right, it's like you take quick loan from MTN, right? For the first time, you still owe quick loan, right? Okay, you still owe MTN because you've never owed MTN before. Now, for the second time, you already had 20,000 in your Momo account and you went to borrow 18,000. What happens? Immediately, MTN will take that 18,000 from that account. Because you have money. Why are you borrowing money? So it works the same way. So if you have a revaluation loss of 18 and there was a previous revaluation gain, this 18 will go and cancel the 20 and nothing left. But assuming I had 16,000 in my account and I went to borrow 18,000, they can only cancel the 16, right? And then you are still owing 2,000. So this 2,000 will go to P&L. Do you get the idea? So in that case, I'll reduce the revaluation surplus by how much? By 16,000, right? Credit, debit the asset, the P&L, okay, also by what? 2,000. With the debit and the credit will still give me the same 18, right? But the asset whole value must reduce by the whole 18,000. Are we okay? Are we okay? Good.
Yes, sir.
Now let's take a question.
Sir,
Yes, please.
you said unless remaining revaluation upwards, cancel something. I'm not seeing your writing. Well.
Unless it's previously, please sometimes just listen to me instead of watching what I'm writing. Because what I say is where I put the value. So I said, unless you have previously revalued the asset, that means any loss will go and cancel. You can't have a loss and a gain at the same time. So that loss must go and cancel that gain. Then any excess will go to the P&L. And I use this illustration that assuming an asset has a revaluation loss of 18, and previously you had a revaluation gain of 20. You can't have a loss of 18 and a gain of 20 at the same time. So you go and set this loss. We look at materiality and aggregation. We look at what? Set-offs. So this is a typical set-off. So you can go and set this off the 20. And that means the gain was more than the loss. So it will eat up the loss. Millicent, are you okay?
Yes.
But here lies the case. Here you are saying that, okay, the asset has a previous revaluation gain of 16,000, but then there's a revaluation loss of 18,000. Can the gain eat up all the loss? Can the gain eat up all the loss? You have a revaluation loss of 18,000 and a gain of 16,000.
No.
Oh, so you can only cancel 16 out of
16,000. Yeah.
16,000 remaining. You take it to P&L.
P&L. Yes.
That is how it works. So I reduce my revaluation surplus by the 16, reduce P&L by the 2, and then the rest goes to the asset account to reduce the asset. This is it. So on 1st January 2016, Kofi B Construction bought a concrete mixer for 120,000. Kofi B uses a revaluation model for its non-current asset. The mixer has no residual value and has estimated useful life of 10 years. By December 31st, 2018, the concrete mixer was revalued to 140. However, by December 2019, its value dropped to 80. Kofi hasn't yet updated his books for the drop in the revaluation. So what do we do? First of all, as usual, what do? We travel, right? We travel, right?
Yes, sir.
Good. And what do we travel with?
Depreciation.
So 1st January 2016, the cost of the concrete mixture was what?
120.
120,000. But what's the depreciation? The depreciation for every year is what?
10
The
years.
1,000 divided by 10 years.
10
And that's
years.
that's 12,000 per annum. No, so good. So we need accumulated depreciation. Where are we traveling to?
2019.
2019 or 31st December 2018. That's where we are traveling to, right? So in that case, I want to do 2016 to 2018, right? Because you are traveling to 31st December 2018. How many years?
Sir, I thought I'm
No,
seeing 2019.
by 31st December 2018.
Ah,
Two.
okay.
So that means 16, 17, 18, right? 3 years gone
Mm,
by 12. 3, 12,
36.
36,000. So we take it out. And what's the carrying amount? So that's at 31st December 2018.
84.
Carrying out 84,000. Okay.
Yes, yes.
Okay. But at this date, what happened? They revalued it to what? 140,000, right? So the same date, 31st December 2018, there was a
18, 19,
revalued amount of
80,
140,000. So was there a revaluation gain?
140.
Yes, 56.
So there was a revaluation gain to OCI of 56,000. Good. All right. Then what happened? In 2019, something happened. The value dropped, right? So
Mm,
as at 1st January 2019, the carrying amount of the asset was now worth what?
80,000.
No, it's still 140.
140.
How much was the asset carrying as at 1st January, not 31st December?
Yeah, 140.
140, yes. But now we are moving to where? Where are we moving?
31st December 2019.
And how do we travel on the account? Using what our good friend called what? Depreciation. Remember? So we need depreciation from January to December, the same 2019. So depreciation, we know that the asset value has changed. Remember? So our depreciation is now taking this 140,000 over the remaining life. And what's the remaining life? It was 10
7.
years, 3 years. So, we
7.
have, so that means how much is our accumulated depreciation for 12 months, right? It's for the whole year.
Mm,
So how much is our depreciation?
20,000.
20,000, right?
20,000.
So we take out this 20,000 and then we are left with what? 31st December 2019 carrying amount, right?
Mhm.
1st December 2019, the carrying amount. And that's how
120.
120,000. But what happened? The
It's
same 31st
revalued.
December 2019, there was a revaluation done, and then it rather dropped to how much? 80,000. So there was a revaluation loss of how much?
40.
40,000. Okay, so this 40 is a reduction in revaluation. And this is at the end of the year, right? So I told you anytime there's a revaluation, you have to tell the examiner that they should check the asset for impairment and even state some indicators of impairment, right? Do you understand? So in that case, what do? We must first debit to reduce what? The revaluation surplus by how much? How much went into the surplus? Initially, there was a revaluation
56.
6,000, right? So
Yes.
we cannot take the whole 56. What do?
We will take 16,000 to P&L and reduce the
No,
56
the
by.
loss is less than the gain. So we can take all the loss from the gain. Then we just credit our PP with the 40,000. Nothing goes to P&L here. Do you all get me?
Yeah.
So, this is a revaluation surplus account. It's a surplus. Balance brought forward, or the balance or the OCI during the year was what? 56. Megwa. And there was a revaluation loss of how much? Can't 40 be taken out of 56?
It can.
So we'll be left with what? 16,000, which we carried forward to the next year. Megwa. Millicent, are you okay?
Listen.
Are you okay?
So sir, first the 56,000 will go to OCI.
Yes.
Then the 40,000.
The 40 is a loss. I told you a loss should go to P&L unless it goes to cancel any previous gain. Was there a previous
Okay.
gain? Yes, there was. So you
56,
cannot,
yes.
and 40 can be taken from 56, right?
Mm.
You go and take it out, right? Good. This one, you see, it wasn't taken to P&L because there was a previous gain that was higher than the loss. Now, I want us to look at another one. Okay. So look at Binary Limited. Please read the notes for me for Binary Limited.
What page is that?
Hello?
Hello,
Please,
Prof.
somebody read and let's go. Read and let's go. But so far,
Binary
so good.
Limited.
So far, so good.
Yes.
Good. Let's continue.
Binary Limited statement of financial position as at 31st October 2024. Property, plant, and equipment are carried after charging depreciation for the year. On 31st October 2024, a piece of property carried at 130 million was revalued to 110 million. This revaluation had not yet been accounted for. The revaluation reserve, included with other components of equity, had a balance of 12 million due to previous revaluation of this property. Show the relevant extract from the statement of profit or loss and other comprehensive income for the year ended 31st October 2024 and the statement of financial position as at 31st October 2024.
So for this piece of plant that we have, we are saying that, okay, as at that 1st October, that 31st October, the carrying amount was what?
130.
It was 130, right? Then what
Yes,
happened?
it was
It was
revalued.
to how much?
110.
110. So what happened? Means that there was a revaluation, what? Loss, maybe
Yes, sir.
of 20,000. So 130 reduced by 20 to become 110. But what happened? There was a previous revaluation gain of how much? Of 12 million. Do you get it? So in that case, this loss must go and cancel the previous gain. Maybe true or false? So in our revaluation, what's the balance brought forward from the previous year?
12 million.
It was 12 million, right? So let's say 12,000. So in that case, we can do revaluation loss of how much? This account can never go to zero. So we reduce it by how much? The same 12 million of the loss, right? So that there's nothing left in this account. But when we go to the P&L, okay, our revaluation loss, we recognize the extra one. So the total loss was what? 20. No, be so.
Yes, yes,
But
sir.
we've already taken 12 from here. So P&L, how much goes to P&L? 8,000.
8,000.
That makes sense to everyone.
Oh, very well.
Yeah.
Hello, Prof.
So yes, please.
So if I get the whole concept about revaluation, for the first time, if your asset is being revalued and there is a gain, you keep it on other comprehensive income as revaluation surplus.
Yes.
Subsequently, if there is a loss, you go and reduce the balance. But for the first time,
yes,
can I continue?
Yes.
Okay. But for the first time, if there is a revaluation loss, because the revaluation surplus account can never go to negative, you expense the loss. Is that right?
Yeah.
Cool.
To the extent of a previous gain.
I mean, for the first time, because there hasn't been
Yeah,
any
for the
gain on the
first time,
asset.
yeah, there's no gain. So the
So
account
you
cannot go.
expense it.
Yeah, you expense
Okay.
it.
Okay.
And if the gain is also not enough, you still expense the rest until the next time.
Hey,
Yeah.
please, how about the statement of financial position figure that we see there
What has
for the
happened?
for the
Oh,
property plans?
to the PPE. So they've given you PPE and the plant is part of the PPE. So what do? It means on the balance sheet, when you go to non-current assets, we are going to say PPE. What was their value? It was 1,000 and 20,000, right? Then you just come and take out the 20,000 loss on the asset. That's all. But the asset need they receive value 20,000, meboa.
Yeah.
All you
Yes.
do is just take it out. So that is why you are seeing 1,020,000. So if you take out the 20,000, you are left to 1 million. Let's look at the journal entry. So what you are doing is that first debit to reduce your revaluation surplus. By how much? The revaluation surplus can only reduce by 12,000. Credit to what? There's another debit to what? The revaluation loss. That goes to P&L, right? The excess, which reduces the P&L by 8,000. Giving you the total 20. Then you must credit to reduce the PPE by the 20,000. So you see, it has balanced of 20 is equal to 20. Accounting equation. Makes sense. Now, one thing I want to introduce is changes in estimates. Like when you change the residual value of an asset or when you change the useful life of an asset, okay, anytime that happens, continue as if nothing happened. It's a change in accounting estimate. So it's a prospective application. So I've taught you how to do this already. If anything changes on the asset, just take whatever is left for the carrying amount over that. So assuming residual value changes, just take the carrying amount minus the residual value all over the remaining useful life. Everything is remaining life. But if the life has changed, if the original life has changed, let's say it was 20 years, right? And this 20,
Yes.
they said now the asset's useful life is 25 years. So if it's 25 years, you now use the new 25 years minus any years they've used already to get the remaining life. That's all. But if the remaining life itself has been revalued, then use the new remaining life. That's all. It's that easy. Then you continue as if nothing happened. So that was the end of IAS 16. Very simple, but detailed. Okay. Mpamucho, be a question, mommy. Before we start with borrowing cost.
Prof, please, you share the board, right?
No, you need to be writing.
Moving fast, sir. And so I can't. I've even stopped writing. I'm only following now.
Pay attention.
Don't worry. You watch the videos.
So pay
Okay.
attention. There is the attention that I need. Understand the concept. Me, I think, sir, most of the time, writing, no, you don't pay attention. You write. So it's better you rather cool down, understand what I'm doing, because on the D-Day, it's not this question that will come. Right? If you want, I can share you the board, but I'm not sure I'll share it. Okay, so in that case, We start with borrowing cost.